Good evening, students. Welcome back to our revision classes. So we are in the last leg of our revision classes for this paper of CA final paper number 5, indirect taxes. Yes, very good evening to everyone. So today I'll first ask you all to raise your queries, doubts, if any of the earlier topics, chapters, in case if you have come across, so that we can also take this opportunity to revise your doubts, clarify your doubts, revise your queries. Any question, any concept you want me to explain, you can put it across. Yes, students. Anybody? No queries? Okay. So now we proceed with the next part in our syllabus of customs. That is the procedural aspect. So in our previous classes, we discussed the levy, the special cases of levy, the exemption. Then we discussed with classification, valuation, types of duty. Now we are moving ahead with the next aspect, next part, that is the procedural aspect. Now, in this procedural aspect, we will be studying the detailed procedure of how clearance will happen both at the time of import export. Yes, we will be studying the import procedures which are more detailed. So you'll find more provisions, more rules, regulations relating to import as compared to export, because the procedures in case of import are very wide. Now, before I go to the provisions, I'll give you a brief walkthrough into the procedure so that when we are reading the provisions, you have the whole picture at the back of your mind, and connecting with the procedure would be easier. So visualize this. A ship is coming from UK to India, and the first port in India that it is coming to is Mumbai port. Now here itself, there are two possibilities. First, the ship will only touch and port at the Mumbai port and no other port, though it may be carrying goods belonging to other ports in India as well. First possibility. In this possibility, what will happen? Since it is carrying goods relating to other ports also, and it is not going to touch any other ports. So firstly, what it will do, it will unload all the goods at the Bombay port. Then the goods which are meant for further ports, like let us say Delhi, Chennai, or wherever there are custom stations, in that particular case, the goods will have to be shifted to another ship or another transport medium so that they can be transported to the other port for which these goods are meant. So in this scenario, where all the goods are unloaded at the Bombay port, the ship will leave. After this, these goods, which are meant for other ports, will be sent to the other ports by transporting it using some other medium, maybe other ship or maybe truck, lorries, etc. This is called as transshipment. So transfer of ship, so transship. Second possibility is this ship is coming to Bombay port, but at the same time, it will also go to Chennai, it will also go to Kolkata. So it means it will be moving to other ports also. In this case, whatever goods this ship is carrying for these other ports, it will not unload at Mumbai because the same ship is going to go to other ports also. In that case, when the ship carries goods to further ports after first berthing at Mumbai, now when it will proceed to other ports in India carrying goods, we call it as transit. So one is transshipment of goods, one is transit of goods. In case of transit, the same ship which had brought the goods to the first port of India will be going to other ports as well. Whereas in case of transshipment, that ship will unload all the goods at the Bombay port, and then another mechanism will be used to transfer it to the respective ports through different other vehicles, maybe other modes of transport. That is why it is called as transshipment. Now, going to further details. Now, when this ship is coming to the Bombay port, before even it reaches the Bombay port, it will seek permission from the customs to unload the goods and the passengers it is carrying at the Bombay port. For seeking this permission, it will have to file a detailed report of what goods, what passenger it is carrying. These reports are nowadays filed online, and it is filed much prior, before the ship even comes near to India. This is so to avoid time. So prior, the ship takes the permission both from the port trust seeking the permission to park the ship, to berth the ship, and permission mainly from the customs allowing it to unload the goods and passengers. The detailed report which the ship has to file is called as Import General Manifest. It is also called in short as Import Manifest, and in case of land transport it is called as Import Report. So for sea and air, majority terminologies are same. For sea and air it is called as Import General Manifest or Import Manifest, and for land it is called as Import Report. Now, after filing of this report, the custom will go through the report. The report contains the detailed list of all goods, whether cargo, whether baggage, whether ship stores, whatever this ship is carrying, and from where these goods are loaded, from which port, plus the ship's logbook as to from where, which all countries this ship is coming from. So all this information is given, which is evaluated to ensure that if there is any restriction, prohibition imposed by the government, like when there are some pandemics, epidemics going on in different countries, or if there are some strained relations with some countries, or if for the time being the government has kept certain countries on the watch list or the radar list, in all these cases, this import general manifest is checked by the customs to ensure that all goods that are coming to India are allowed to be unloaded. Only then it will allow the permission to the ship to unload these goods and passengers. This permission is called as permission of entry inwards. The name suggests that this is the permission allowing the ship to come inside India. Technically, it is not. It is the permission allowing the ship to unload the cargo, the passengers that it has brought along with itself. First part. Second point is that similar to this import general manifest, the ship also has to submit another list called as the passenger list, where the details of all the persons traveling on that ship, on that aircraft is also shared for the same reason, security reasons, monitoring reasons, so that the customs can check who is coming to India, who all persons are named, from where this ship is coming, and from where these persons have onboarded the ship or aircraft, so that they can decide whether or not to allow these people to get uh, unboarded from the ship or aircraft. So these are the first steps. Now, most important, the first condition which is put upon the master of the ship or the pilot in charge, all these people are called as person in charge. The first most condition put by the act on the person in charge is that when they are carrying goods or passengers and they are coming from a place outside India, they should compulsorily first call at any custom port airport in India. Means they cannot land, they cannot come to a port airport which is not having a customs office, which is not a custom station. So they should compulsorily come to a port airport which is uh, announced by the government and where the custom authorities are there. This is the first condition. Then they have to take this permission of entry inwards by filing this report. After getting the permission of entry inwards, the ship will start unloading at destined places, at specified places, and only when the custom authorities are available for supervision. So the ship cannot unload these goods when the custom authorities are on holiday or it is an off day for them. So this is again a condition. Then after unloading, these goods go to the control of a custodian who is the Port Trust of India. So these goods are not given to the importer immediately. They will go into the custody of the authority appointed at the port, generally, which is the Port Trust of India. Over here, it is called as the custodian. Now, when these goods are being unloaded or are kept with the Port Trust Authority, that is a custodian, the importer is required to make an application to the Customs Department. This application is called as Bill of Entry. In this application, the importer is requesting the custom authorities to clear these goods. Clearance means do assessment, checking everything, and allow the importer to take these goods. Now, this bill of entry could be filed for three purposes. One, re-export. Two, clearance for home consumption, that is final clearance. Third, removing it from port but shifting it to a custom warehouse, which is called as bill of entry for warehousing. Now, depending upon the bill of entry, the processing is done. If the goods are to be re-exported, accordingly, it is marked on the bill of entry. And then whenever the importer has to re-export the goods, he will file the shipping bill for doing the re-export. Second, if the goods are to be cleared permanently, finally, which is called as cleared for home consumption, the importer has to pay the relevant duty applicable on the goods and the goods will be cleared. Third, if the goods are not to be cleared immediately, but to be shifted to the warehouse temporarily, and it would be cleared from there later, the importer will mark in the bill of entry as clearance for warehousing. In this case, the importer does not have to pay the duty, but provide a bond covering 3 times the amount of duty that is assessed at the time of importation. After giving the bond and the relevant security, the goods will be shifted from the port to the custom warehouse. Again, we will be discussing in detail the warehousing provisions in the next chapter. So this is how the procedure happens. Importer will pay the duty and get the goods from the custom authorities. In case the goods are kept in warehouse, within the warehousing period, importer can again approach the customs, file the second bill of entry, which is called as X bond bill of entry or bill of entry for home consumption. Now this is the second one because first was filed at the port to clear the goods from port and shift it to this warehouse. Now it is filed for clearing the goods from warehouse. Now it will be filed one for clearing it permanently, which is called as clearance for home consumption, or for shifting it from this warehouse to another warehouse. That is also possible. So again, depending upon what is the purpose. So if it is to be shifted, again necessary bond, etc. is given and the goods are shifted to the other warehouse. And if it has to be cleared, the assessment will be done again. And now whatever is the final duty, the importer has to pay the duty along with the relevant interest, the warehousing charges. And now the goods will be finally shifted to the, sorry, not shifted, now will be finally given to the importer because now the importer has paid the duty and the bond which the importer had given would be released. So this is broadly the overall procedure. Now, with this backdrop in mind, let me take you to the detailed point in this chapter. We will start with the important definitions. So first is the definition of conveyance. So conveyance, as you all understand, is the means of transport. Now this conveyance will cover all the modes. So for sea, it is vessel, for air, it is aircraft, and for road, it is vehicle. Next, exporter. Interestingly, if you remember in the first lecture, I had said that in customs, it is not necessary that the owner of the goods is only the importer or exporter because the definition is wide enough to cover anyone. So how that you'll understand from both these definitions. If you see both these definitions of importer and exporter, how it is defined, it says in exporter in relation to goods. So exporter in relation to goods at any time between their entry for export and the time when they are exported. Means either the owner, beneficial owner, or any person holding himself out to be exporter. So it can be anyone. So not only the original owner, it can be even the beneficial owner or the person who holds himself out to be the exporter. Same is the definition of importer in relation to goods at any time between their importation into India, and the time when they are cleared. Any person who is either the owner, beneficial owner, or any person who is holding himself to be an importer. So that is the extent of the vastness of this definition. Then you have the definition of foreign going vessel or aircraft. Now, as the name suggests, it refers to that vessel aircraft which is going out of India. But what is important is here, it does not only cover the vessel which is going in the normal cases, it covers all vessels. So it is not that a vessel which is used for transportation is only covered. That is the first one. So first is a transport aircraft, that is by which either the passengers are traveling or the goods are being transported. That is covered. Second, even a vessel which is belonging to a foreign government which had come here for taking part in some naval exercise. Now you'll find that regularly it is a bilateral or trilateral military exercises which are done, which also includes naval exercises where two or three countries together, their armies come together or their naval forces or their air forces come together and they do a joint training. So even where a naval vessel of a foreign government had come for participating in any such naval drills, and after completion of this training and drills, if it is going back, still we want to exercise control. Please understand, customs is not only for tax. We are also looking at this from the perspective of ensuring that there is nothing which is going outside India without the government control, without the government intervention, and similarly, nothing is coming into India. Hence, when you read customs law, read it from this perspective that it covers everything and not only those things where duty is applicable. So foreign government naval vessels are covered. Then vessels which were engaged in fishing and other operations. So many times there are vessels which are outside India. Their intention is not even to come inside India. Their purpose was fishing and other operations, and that is even outside the territorial boundaries of India. Still, again, why these are covered? For the same purpose, keeping a watch, surveillance. Is it that they are truly here for fishing, or they have some other intentions and they are waiting here, and on right opportunity they may strike at India, they may uh, do some what you can say attack on India. So for such reasons, even such vessels which are outside our territorial boundaries are also under surveillance. And then any vessel aircraft proceeding to a place outside India for any purpose, this even includes a hijacked aircraft. So this is the vastness of this definition, and the purpose is again control, surveillance, monitoring, and not only duty. Then comes another important definition, that is the definition of person in charge. Now, who is person in charge? See, person in charge is nothing but the person who is having the control over the conveyance. He is that person who decides where the conveyance will go, where it will land, when it will take off, everything. So this person is what is, sorry, person in charge. Now, as the name suggests, for vessel, who will be person in charge? The master. For aircraft, it is the commander or the pilot in charge. So many times you have two pilots, but it is that pilot who is in charge. Then railway, train, it is the conductor or guard who is having the direction of the train. And in case of any other conveyance like truck, lorries, it is a driver. So these are the person in charge. Now, the definition of entry. Again, when we read the word entry, it means coming in. Here, entry is not coming in. Then what is entry? Here, entry means the entry that we are making. Like how we say we have passed journal entry or we have made some entry in the ledger. So, entry means noting. So, what is the noting or the entry here means? In relation to goods means an entry means noting made in the bill of entry, the shipping bill of export. So, these are the documents through which goods are cleared. So, when an entry is made in these documents, that is what is called as entry and not coming inside. Includes entry made under the regulations under 84 with respect to post or courier. Now starts the procedure. So first is section 29. Section 29 has put responsibility on the person in charge. What is the responsibility? The person in charge responsibility over here is that whenever he is entering into India, he should only call or land at that place which is a custom port airport whenever he is coming into India for the first time, and most importantly carrying passenger cargo, unless he is allowed to land at any other place by the board. So if he wants to land at any other place, let us say there is some private uh, helipad or there is any private what you can say the airport, the aircraft can land over there provided it has taken that special permission. Otherwise, it has to come to the custom port airport only. Now, the exception to this is that it will be allowed to land at any other place only when compelled by accident, stress of weather, and other unavoidable reasons. That we all can understand that if there is any such thing, it will not wait to reach the custom airport, it will land at any nearest port airport. Second, whenever it is landing at a place other than the custom port airport, then the additional obligations put on this person in charge is that after arrival, and since it is arriving at a non-custom port airport, it has to immediately contact the nearest custom officer, and if not, the nearest officer in charge in a police station, and hand over the details, especially the logbook, to the police. Then without the consent of this custom officer or police officer should not allow unloading of goods or passenger, again except where it is compelled by some situation like the aircraft has caught fire or there is a possibility that it can blast. So only in such exceptional circumstances, to protect the health or life of the crew and also to protect and preserve the property, then only it can allow the goods to be unloaded or the passenger to disembark. Otherwise, without the consent of the officer, he should not allow it. Then comes the second procedure. So when it is coming to India and it wants to unload the goods, it has to take the permission of entry inwards. But for that, it has to file this document which is called as arrival manifest, import manifest, or import report. Now, where goods are brought by aircraft or vessel, it is called as arrival manifest or import manifest. It should be filed before arrival and only in electronic form. Obviously, both these points go hand in hand. When we say before arrival, it has to be in electronic form only. Next, when the goods are being transported by vehicle, then the document to be filed is called as import report, and it can be filed even after arrival up to maximum 12 hours in the prescribed manner, which will include manual also. Further, the principal commissioner may extend this timeline if required or allow it to be filed in any other manner. Penalty for not complying with the above timelines is up to rupees 50,000. And if the proper officer is satisfied that the above manifest or report was incomplete and there was no intention to evade tax, something was missed to be written by omission, by some genuine error, it may allow that the above report or manifest may be amended. Next, similar to import manifest, that is a list relating to details of goods, you have to also file the list relating to details of the person. So the next report to be filed is passenger and crew arrival manifest, in which the passenger name, from where they are coming, which country they belong to, all these things are to be reported. Same. If you have not filed it, or if there is delay in filing, the penalty can be up to 50,000. Now, next is after filing the above report, the customs will scrutinize and check it whether all the goods persons which are coming through the ship vessel are eligible to be unloaded in India. Then only they will allow you the permission of entry inwards. Again, entry inwards is not the permission of coming in India. Entry inwards is the permission to unload the goods. So the master of the vessel is not permitted to unload goods until the order of entry inwards is given. Order will be given only after you have filed these reports and the proper officer is satisfied. Exceptions: unloading of baggage, which is accompanying the passenger or the member of the crew, or mail bags or animals or perishable hazardous goods may be allowed. So these things may be unloaded even before the entry inwards permission is given, obviously if the officer allows. Next, goods which are imported cannot be unloaded until they are mentioned in the import report or import manifest. If you are unloading them, it tantamounts to smuggling. So only those goods which you have mentioned in your import report, import manifest as goods which were meant to be unloaded on this port, only those goods can be unloaded. The other goods cannot be unloaded. Next, loading and unloading of goods only at the specified places, approved places. Next, they have to be unloaded only under the supervision of the officer. Exception: board may give general permission, or the proper officer may give special permission in particular case where it may be unloaded without their supervision. Next is restriction on goods being waterborne. Waterborne means carried in the water. Now, this point is applicable where the port or the water near the port is very shallow. Now, in such cases, huge ships may not come, cannot come to the port because the ships will get stuck up in the shallow waters. So these ships are always berthed far off from the ports. Now, when they are berthed far off from the ports, then whatever goods are to be either loaded or unloaded from these ships will be transported to the ship or brought from the ship to the port using small boats, or if possible, the laborer would be carrying the goods on their heads and taking it by walking in the water along with the goods. Now, when such a situation is there and your goods have to be loaded, unloaded using people carrying the goods on head and walking in the water up to the ship or through small boats, there is a possibility that any of these things can be diverted and they may not reach the port and they may be smuggled without going through the customs channel. To avoid this, the requirement in such ports is that there has to be a permission to be taken, and this permission is called as the boat note. So basically, a list of goods will be prepared as to what all goods are, let us say, to be loaded on this ship or are to be unloaded from this ship. And strictly, the customs will ensure that these goods, which are carried through people on their heads going into the water carrying the goods or through small boats, are ultimately either loaded on the ship and the ship leaves India, or if they are to be unloaded, they are brought to the port up to the customs. So this is what is the boat note procedure, and this is what is restriction on goods being waterborne. So without this boat note, your goods cannot be carried in water up to the ship. Now comes the assessment. So now, once your goods have unloaded, now you want to clear the goods. For clearance, as I said, you have to file bill of entry at the time of import. Now, when you are filing bill of entry, what exactly is the purpose? The purpose is requesting the customs to assess and clear your goods. Now, assessment and provisional assessment, there are two provisions. So assessment is where calculation is done by yourself, applying the rates, classification, etc. Provisional assessment is where, sorry, you, that is the importer exporter, is unable to decide on the correct value, correct rate. In such cases, you approach the officer, requesting the officer to give you a rate at which you can do assessment or the value at which you can do assessment. Now, in this case, even if the officer is unable to do it, then the officer will give you a temporary rate and value at which you can do assessment so that at least you can clear your goods. Now, this is what is provisional, because the rate which you are going to use is not the final rate, because even the officer cannot give you the final rate immediately. But since you have approached the officer, he has to give you a rate so that you can clear your goods. This is a temporary rate. So this is called as provisional assessment. So the rate value given by the officer is temporarily taken. You compute the duty, you pay the duty. But since this is not the final, in that particular case, you will be required to provide further information details as asked by the officer. And then finally, after providing all these details, your assessment would be completed and you will be either required to pay the balance duty with interest, or if excess was paid on provisional, you will be given the refund. Now, when you are doing provisional assessment and clearing the goods, there is a possibility that the officer may ask you to furnish some security. Why furnish security? Because tomorrow, if you do not turn up for paying the balance duty, so it should not be a loss to the government. So they are taking a security, and then within a specified time of 2 years, they will be completing this assessment, which will be final assessment. Next, voluntary revision of entry post clearance. Now, what is this? In case when you had done your self-assessment, if later on it was found that there is some mistake, something was incorrect, then the duty may be reassessed and the officer can check your reassessment. And if everything is found to be correct, if the duty at the original assessment was excess, you can claim refund. If it was short, you will pay the duty along with interest. Now, the duty which is self-assessed based on the revised entry will become your final duty, and the importer exporter is allowed to now use this for all future purposes. So this is what is the broad procedure. They have repeated this procedure here. So first, goods should compulsorily come at custom port airport. You have to file the report. On the checking and confirmation, the permission of entry inwards is granted. Goods to be loaded, unloaded only at specified places and under supervision during working hours. The goods go to the custody of the custodian, and then you file the bill of entry, which may be three: for warehousing, for transshipment, or for home consumption. Where it is for warehousing, then later on again another bill of entry will have to be filed for final home consumption. Duty is self-assessed and paid, and after payment, order for clearance is passed. Now, similar to the import procedure is your export procedure. In case of export, when you want to export your goods, you will bring the goods to the port. After bringing the goods to the port, you will file the shipping bill or the bill of export. So like in case of import, we had the bill of entry. In case of export, we have the shipping bill or bill of export. After filing this bill of shipping bill or bill of export, again, this shipping bill or bill of export is given to the proper officer. If any duty is payable, it is assessed and paid. And if the proper officer is satisfied that the goods which are brought for export are not prohibited and the exporter has paid duty, if any, the proper officer will pass order clearing the goods and allowing loading of the goods. Now, once the proper officer gives this permission that yes, now I have checked, everything is fine, you can load, the goods are finally loaded on the conveyance, and after getting the final permission from the proper officer, the ship may leave India. Now, how the ship will leave? Again, the ship will have to give the export manifest. Like in case of import, they were giving import manifest. In case of export, they will give export manifest, which is again the list of all goods which are loaded. Again, the proper officer will check whether they have covered all the goods, and whatever goods are loaded on the ship, whether or not they are all assessed through shipping bill. If this matches, the proper officer will now grant the permission of entry outwards. And in that case, only the ship can finally leave India. So this is broadly the export procedure relating to this. Just a minute. Now, what are these baggage goods? See, baggage means your luggage. Now, in case of baggage, why you need these baggage goods? So, the general rule is anything which is coming into India, which we call as imports, and going out of India, which we call as exports, is liable to customs. Now, again, we keep export aside because majority of exports are non-leviable or are exempt. So, mainly for imports, majorly everything is taxable except those which are exempt. Now, interestingly, when it comes to your personal luggage, there is always a question or there is always a doubt, ki, sir, whether even for our personal luggage, which is our personal item, our daily use items, still the customs will apply. The answer is yes. So the custom has no distinction between whether these goods are meant for your business and trade or whether they are your personal goods. Anything coming into India is what is leviable to customs. That is what is the provision. Now, having said this, it would be very unfair if you tax those goods which are my personal belongings, which are my personal use items, because then it will be that I will be paying tax on those goods which I'm using daily for my day-to-day basic necessities. Also, at the same time, it should not happen that people are carrying, like there was a time people used to bring multiple laptops in their bags. They used to bring multiple watches in their bags. And these are all high price items. And under the name of baggage, they were allowed without paying duty. So people were indirectly doing business by bringing it under the name of baggage. So there was a necessity of bringing in some rules whereby genuinely personal use items have to be allowed without paying customs. And at the same time, all of these electronic goods or special things like, let us say, somebody's carrying liquor, somebody's carrying cigar, tobacco, even arms, like many times in foreign countries, you are allowed to carry a licensed pistol. So over there, carrying of a revolver maybe is allowed in their country's rules. So you require some norms to decide what will be allowed as a part of your baggage, that is your personal luggage, without payment of customs, what will be allowed to a certain extent without payment, and beyond that it will be required to be duty paid. So for that we had baggage rules. These rules are as old as the customs law, but they have been revised obviously for revising the monetary limits, and now you are given this table which is called as the general duty free baggage allowance. So what is baggage allowance? It is the amount up to which you can carry certain items in your baggage and they would be duty free. Now, what are these items and to what extent they are duty free? That depends upon two things. One, who are you? Who are you means whether are you Indian resident or are you a foreigner who is coming to India for a short period of time, that is what is called as tourist, or are you a person who is permanently shifting to India? Are you a person who had gone out of India for some business purpose, for some project of 1 or 2 years and are now coming back? So, depending upon first who you are, and second, from where are you coming? Which country are you coming from? These two things decide the amount up to which you may be allowed to clear your baggage duty free. So, in case of Indian residents and even foreigners who are residing in India, or tourists of Indian origin, excluding infants, because for infants the limit is lesser. And if they are coming from any country other than Nepal, Bhutan, Myanmar, what is allowed duty free? Used personal effects and travel souvenirs and articles excluding Annexure 1 articles if carried on in person or accompanied in baggage up to the value of. So, up to what value they are allowed duty free? 50,000. Second, a tourist of foreign origin, again excluding infants because for infants there is a different limit, it is 15,000. And then Indian resident or a foreign resident residing in India or a tourist excluding infants and now coming from the country of Nepal, Bhutan, Myanmar, they are allowed rupees 50,000 if they are arriving by land. Next, infant passengers, only UPE allowed. That is, UPE is this used personal effects. So use personal effects allowed duty free, and the general duty free allowance of a passenger cannot be pooled with general duty free allowance allowance of any other passenger. Means what? If I am allowed 50,000 limit, so you are also allowed 50,000 limit. Now let us say you alone are carrying goods worth rupees 75. You cannot say that we will merge mine and your limits together and you will be able to claim the exemption up to 75,000. No, that is not allowed. So the limits are to be checked per person. They cannot be pooled. So if you are carrying goods which is worth 75,000, then you'll have to pay duty on 25,000 and you cannot use my balance duty free allowance. Let us say I'm not carrying anything or my goods are worth only 5, 7, 10,000. So my balance 40,000 cannot be pooled with you. Second is to what extent jewelry can be brought. So person residing abroad for more than 1 year and coming from any country. So how much jewelry they can carry? They can carry in case of a gentleman jewelry up to 20 grams with a maximum value limit of 50,000 and for lady passenger 40 grams with a maximum value limit of 1 lakh. Now comes the situation of transfer of residence. What is transfer of residence? So I was staying abroad, I was working abroad, and now I want to shift my residence back to India. Now, in this case, depending upon for what period of time I was working abroad, I am allowed the duty-free allowance. Now, what is the purpose of here allowing extended amount? Because when now I'll be returning back, I will also be bringing along with me household articles. So besides my personal items, I may also be carrying some household items, and that is why the duty-free allowance is slightly higher. Now it depends upon my stay abroad. If my stay is between 3 to 6 months, up to 60,000, 6 months to 1 year, 1 lakh, up to 2 years, that is 1 to 2 years, it is 2 lakhs, and above 2 years, it is 5 lakhs. Now, when these higher limits are provided, there are some conditions to be satisfied. So first, here in case of Indian passenger should not have availed this concession in past 3 years. Now this is important. So where you are opting for this higher limit, why? Because you have stayed for more than 1 year but less than 2 years. It is important that it should not have happened that you had already gone to some other country, came back from there, took this heavy allowance of 2 lakhs duty free. Then within 6 months, you went to another country, stayed there for 1.5 years, came back. So it should not happen that you are availing this higher allowance in short period of time. So they have kept a cooling period of 3 years. So if you want to claim this allowance of 2 lakhs now, it should not have been claimed in past 3 years. Yes, maybe prior to 3 years you have claimed, that is fine. It means you should have stayed in India for minimum 3 years after you have shifted your residence in simple. Now, minimum stay of 2 years or more. In this case, up to 5 lakhs is allowed. But what are the conditions? The minimum stay of 2 years abroad immediately preceding date of his arrival on the transfer of residence. So you should have completed minimum 2 years of stay abroad. The shortfall of up to 2 months stay abroad can be condoned if early return is on account of terminal leave, vacation, or any other special circumstances. So in 2 years, if 2 months is shortfall, that is you have stayed outside for 1 year, 10 months, and you are shifting, so we'll still count it as minimum 2 years, provided why you have come 2 months early. So maybe because of your terminal leave or because you are enjoying your vacation period because you are allowed vacation. So if you have not availed that vacation, now you are availing the whole vacation. So you are taking a termination early or for any special reason, which may be health, somebody's death, etc. Total stay in India or short visits during 2 years should not exceed 6 months. So for these 2 years, when you are staying outside, you could have made short visits to India. If you have made the short visits to India for meeting your family, friends, or for attending some events, it should not be more than 6 months in that 2 year stay. The principal commissioner may condone short visits in excess of 6 months, again in special circumstances. Passengers has not availed this concession in past 3 years. Similar to passengers, even for crew, the baggage rules also apply to crew engaged in foreign going conveyance for importation of their baggage when they are finally paid off on termination of their engagement. So crew is hired for multiple travels, and after a particular shift of the crew is over and they are finally coming back, they are clearing their goods, and at that time they will check the same rules. However, other crew of vessel and aircraft are allowed to bring items like chocolate, cheese, cosmetic, and other petty gift items for their family up to a value not exceeding 1500. Now, these are some annexures because in the above rules for certain duty-free allowances, some of these annexure goods are not eligible. You may need not learn this, just you should know that there is such annexure restricting certain goods for the above duty-free allowance. The next point is unaccompanied baggage. Now, what is unaccompanied baggage? See, we are giving the above relaxation because it is your baggage, that is your personal luggage. And how you come to know that something is your baggage? Because you bring it along with you. However, the customs law provide for a special situation which is called as unaccompanied baggage. What is this unaccompanied baggage? Unaccompanied baggage is that your baggage is not coming at the same time when you are coming. So either it is coming before your arrival, it means you have sent the baggage first, maybe because you will be traveling to multiple places coming, or because you had a lot of baggage, so you decided to send whatever is extra before, or it will be coming after you have come. So in any case, where the baggage is not coming with you, it is called as unaccompanied because it is not coming along with you. The law says that even an unaccompanied baggage will be allowed duty-free allowance on the same lines as accompanied baggage. It means even though the baggage is not coming with you, it will still be treated as baggage, and up to the maximum limit given above in different scenarios, 50,000, 60,000, 2 lakhs, 5 lakhs, whatever, you will be allowed to clear your baggage. Now, how much before and how much later the baggage can come to fit in unaccompanied baggage, they have given. So our provisions also applicable to unaccompanied baggage unless excluded if unaccompanied baggage has been in possession abroad of the passenger and is dispatched within 1 month of his arrival in India. So after you are coming, it can come maximum after your arrival up to 1 month. Still will consider it as your baggage only. Second, it can land into India up to 2 months prior. So before your arrival, if it is coming, it can come up to maximum 2 months. So the date when you are coming, you have to go back 2 months. Within that period, it can come. However, if the passenger is not able to arrive within 2 months due to some circumstances, like there was a lockdown, there was some war, so travel was restricted, or there was some medical reasons, then this 2 months can be up to 1 year. Next is whenever you are coming and you are carrying baggage, like for example, in case of regular imports, you file bill of entry. Here you don't file bill of entry, but you have to clear this baggage also. You have to give the declaration of all the above things, what you are carrying, what is the value, etc. This is done in a special form given to you, which is called as the baggage declaration form. So you are required to fill in this declaration form, and in that declaration form, you have to mention all the things. It is very important that you disclose everything honestly. In case upon checking, if anything else is found in your baggage which is not mentioned in your declaration form, it tantamounts to smuggling. Now, this declaration form has to be filed, and beyond the above limits, whatever you are carrying, that will be leviable to duty. There is a flat rate of 35% duty on baggage. So this is all about the first chapter. I have few questions in the box, so I'll go through them. So Miss Leela is asking me these questions. She says, first, in case payment not made within 180 days. Acha, so you're talking about GST. Fine. So she's asking, condition is reversal of ITC along with interest. In that case, what is the rate of interest? But the interest is always 18%. I know there is a written 24%. That 24% is written as the maximum outer limit. So it is up to 24% that they can charge. But it is further saying, if you read the interest provisions, it is saying at the rate which will be notified not exceeding 24%. So presently the notified rate is 18 via notification. So presently all interest under GST is 18, nowhere it is 24%. So this you can simply remember. Next, what are you saying? PG now 10,000 rupees. Acha, acha, you are saying gold per gram. Actually, it is type COLD code PG now. So I was not able to understand. So you are saying gold is now. See, this has happened in a very short period of time. And as you can see, these rules were last revised in 2016. So at that time, 20 grams would have come in the amount which they have mentioned. Correct. So that is why it is correct. Yes, considering the rise in prices of gold, and if they feel that this value will be continuing, they may even revise this amount limit. But as of now, Swaminathan, the limit is what it has been given above, unfortunately. So you are right. You will not be able to bring the entire quantity which is mentioned, because value-wise, the quantity which will fit within the value limit, which will be much lesser, because presently the prices of gold are very high. Correct. Now we come to the warehousing provisions. Now, what are these warehousing provisions? Now, as we discussed, when goods are brought into India, that is, they are imported, the importer is given an option that either, if you want, you can clear them immediately by paying duty, or you can shift it to a warehouse, which is also called as a bonded warehouse. Now, the goods, when they are shifted to a warehouse, which is bonded warehouse, then in this particular case, you are allowed to defer the payment of duty. That is what is the first advantage of keeping the goods in the warehouse first. So this warehousing facility offered by customs is a special facility whereby not only your goods are kept in warehouse, but also your duty payment is deferred. So this facility is given, one, because generally importation happens in huge quantity. So practically you do not have that much storage space in your factory. Also, this huge quantity cannot be consumed immediately for any production. So in such cases, obviously, the use of the goods is not there immediately. So one reason why warehousing is required. Second, it also allows you to defer the payment until you are finally clearing the goods. Now for this, you have a special whole provision which is allowing you for the warehousing. What does the provision says? Now before you go to the detailed warehousing provisions, we need to first understand what are the different types of warehouses. Originally there were two, now there are three. So public warehouse is the warehouse of the government itself, which it has set up, and private warehouse is your own warehouse. Now, a public warehouse, which is set up by the government at different places, will be used for warehousing goods belonging to any importer, whoever opts for warehousing. Whereas a private warehouse, which is licensed by the government, it is used to deposit, or it is allowed to deposit only the goods of the importer to whom this warehouse belongs. So private warehouse is generally done by those people who are regular importers and whose business involves huge quantity of imports at a regular time interval. So instead of they hiring a warehouse, they may themselves set up a warehouse, and they may get it licensed so that it can be treated as a custom bonded warehouse. Now, besides this, for certain notified goods, which are obviously of some special character, and where it is necessary to have a proper check on those goods because of the nature of the goods, the sensitivity, there is a third category of warehouse which has been recently added, which is called as a special warehouse. This warehouse is under the strict physical control of the customs because of the sensitivity of those notified goods which are kept. Now, what is the procedure? So when you have to transfer your goods from the port to these warehouse, then there is a specified procedure. The procedure is that you apply this in your bill of entry. In the bill of entry, you mention that yes, I wish to keep these goods in the warehouse. And for this purpose, you have to give a warehousing bond. That is why these warehouses are also called as bonded warehouses, because because in customs, the goods which are stored in the warehouse are only under the cover of a bond, that is, they are backed by a bond. Besides the bond, you also have to give security to cover the amount of three times of the duty involved. So, only after the importer has furnished the bond with the relevant security amount, then only the importer can first keep the goods in warehouse, or if it wants, ship the goods from one warehouse to another warehouse, and all this is allowed without paying the duty. That is what is the purpose. Now, how much is the duty? The duty is, or sorry, what is the value of the bond? The value of the bond is three times the duty assessed. So you are not paying the duty, but thrice of the amount, you are giving them a bond along with the equal amount of security. And on that basis, you need not pay the duty immediately, and the goods are allowed to be kept in warehouse. Now, in this, there are two bonds. One is the consignment bond, that is, which is given for one particular import consignment, to a general bond. Now, what is a general bond? Where in case of an importer, the importer is regularly importing goods, keeping the goods in warehouse, removing the goods from warehouse. So for such importer, every time giving a bond at the time of keeping the goods in warehouse and then cancelling the bond when he is removing the goods is very cumbersome even for the importer and equally for the customs to maintain so many bonds, etc. So to ease out that, for regular importers who are regularly using warehousing facility, for them, they can give a lump sum amount bond at the start of the year. Let us say I give a bond equal to the value of 100 crore. Now my first consignment is imported where the duty involvement is of 10 crore. 3 times of 10 crore is 30. So when I keep these goods in warehouse, out of the 100 crore bond which I've already given, so let us say 100 crore is credited in my name, 30 is debited. So I'm using the bond up to 30 crore. Another consignment comes where the duty element is 15 crores, thrice of that is 45. Again, I debit it by further 45. So out of 100, I've utilized 75. In the meantime, out of my first consignment, which had the duty component of 10 crore, now I'm removing the goods from the warehouse after paying the relevant duty. So again, the 30 crore which I have debited would be created. So this type of a passbook type of entries are made, and there is one lump sum amount given to the bond, which is what is the concept of general bond. Now, the most important point relevant for us in the bond chapter or the warehousing chapter is this part, that is up to what period the goods may remain in warehouse. So the customs allow you to keep goods in warehouse, but this comes with some timelines. Now, what are the timelines? The timelines depends upon the nature of goods and who is the importer. So first is goods for use in any warehouse where manufacture or other operations are permitted under section 65. For capital goods, there is no time limit. It is until the clearance of such goods, and for other goods, till the consumption or clearance of such goods. So first category is where you are using warehouse not only for warehousing but also for a special purpose, which is called as manufacture in warehouse. So this is a special provision under section 65, which we will be studying very soon in this chapter later, that you are even allowed to carry out manufacturing operations while the goods are in warehouse. Now, when your goods are in warehouse and you carry out manufacturing operations, so for such goods, they can remain in the warehouse for any period of time till you want to clear them. So even the machineries which you have brought to do the manufacturing and your goods on which manufacturing is done, the waste, the raw material, everything, this can remain in warehouse till you are actually clearing them. For all other goods, other than the goods which are for manufacturing purpose, so in other words, when a regular importer imports the goods and keeps in warehouse and he's not going to do any manufacturing in the warehouse, so he wants to keep in warehouse and later on clear, the time limit is 1 year from the date when the goods are permitted to be deposited in the warehouse. Now, having read this, what is very important is also the interest. Now, when we talk about interest, in case of warehouse goods, where the goods are kept in the warehouse under section 65, that is for the purpose of carrying out manufacturing operations, no interest is payable. This is applicable for capital goods which are kept in the warehouse. Other than this, for all other goods, irrespective of the time up to which they are allowed to be kept in warehouse, the interest meter will start after 90 days. So this is important to be kept in mind. So you are allowed to keep, let us say, the goods in warehouse up to 1 year. In case of manufacturing operations, other than capital goods, it can be kept up to the time it is consumed in manufacture or it is cleared. But in both cases, even though I'm allowing you a longer period to keep the goods in warehouse, but for the purpose of computing interest, the timeline is 90 days. Means once your goods which are kept in warehouse cross 90 days, thereafter the interest meter starts. What will be the rate of interest? The rate of interest will be 15% per annum. Amount on which the interest is calculatable, obviously on the duty component, and period, the period is beyond the 90 days. So from the date the goods are deposited in the warehouse, thereafter up to 90 days, no interest. Beyond 90 days, you have to pay interest till you clear the goods. Now, while the goods are lying in warehouse, as the owner, what are your rights and powers? First, you have right to go and inspect your goods time to time. See, when goods are kept in warehouse, you are also concerned about the upkeep, about the quality, about the safety. So you are allowed to go and inspect your goods. Why you are doing so? Ensuring that they do not deteriorate or are not damaged. You are also allowed to sort the goods and separate goods which are damaged or are of low quality, or you can keep it, do grading so that whenever you want to show it for sale, you can show it according to the grade. And interestingly, you can even take permission, and the customs can allow you to bring your prospective customers in the warehouse so that you can show your goods to them. So that is also allowed. Now, coming to that warehousing manufacturing part, which is under section 65. So the customs law allow you to keep or carry the goods in warehouse, not only for storage, but also for those scenarios where, let us say, an importer has imported cloth. He has export order in front for shirts. So what he has to do, he has imported cloth, let us say from Dhaka, Bangladesh, and he will be making shirts out of it and exporting it to US. Now, what he could have done, he could have first brought the raw material, that is the cloth which he has imported from Bangladesh, up to his factory, incurred the transport cost, then the manufacturing in the factory, again incurred the transportation cost, then all the custom clearance and all the routing in the customs, and then exported the goods. This would have led to a lot of time wastage in all both side transportation, and also this could have led to increase in cost, because as you all know today, logistic cost is very high and it is a major component. In fact, there was a report which I was reading, why Indian goods are not so competitive in foreign market. Why is the cost higher? One component of that is our transport or logistic cost. So as compared to countries like China, it is not their only manufacturing is cheaper. Maybe ours and their manufacturing cost may not have much variation, but still our goods get more costly by the time they reach the foreign market. One of the major reason is the component of logistics, that is transportation. So adding both side transportation and logistic cost can make your goods very costly. So keeping this in mind, the custom provisions allow you that you can take a part of the custom warehouse and make it a mini manufacturing area like your factory, by bringing in the machines, by bringing in the people who will be working on the machines. So it is as good as you have taken one area of the entire customs to be used as your personal area where you will be carrying out the manufacturing process. Now, when you do this, it is covered in section 65, which allows you to do so, obviously, after taking proper permissions and giving the relevant bonds. Now, in this particular case, when the goods are in the warehouse, let us say I imported this cloth and now I'm carrying out the manufacturing of shirts and I will be exporting the shirts. There is no import duty on the material which is used in the shirts. So let us say whatever meter of cloth I had imported from Bangladesh, out of that 95% meter of the cloth is consumed in the shirt. Balance 5% of the cloth is wastage. Now comes the main important point, that is how assessment is done. So for whatever cloth which is converted into shirts which are exported, there is no duty incidence because, acha, interestingly, there is no duty on the input side also, that is import side also, and on the output side, that is export side also. Why? Because if you remember, in customs, the final conclusion for levy of customs duty, import duty, is only on clearance from customs, not when the goods come into India. So, since I have not cleared the goods from the customs, the goods are still in the warehouse. I've carried out the manufacturing in the warehouse itself. So, technically, there is no clearance and hence there is no liability to pay the customs duty. So, to the extent I have exported the shirts, whatever was the raw material, that is the cloth, the imported material included in the shirt, there is no custom incidence. Question is, what is the treatment of the waste, that is the remaining 5% of the cloth, which has arisen during the process of manufacturing of these shirts? Now, here comes the important point. Acha, one more thing. If let us say out of the total shirts which I have manufactured in this warehouse, I've exported majority of them, but few of the shirts I want to bring it into India. I'm allowed to do that, but to that extent I'll have to pay customs duty because now I'm bringing that much quantity of material. I'm clearing them in India, so I'll have to pay customs duty. Now, what about the waste? So the 5% of the total cloth material which was imported has now become the waste, which normally happens when you are doing the tailoring process. Now, in this particular case, what will be the tax treatment of this waste? Now, that depends upon what you did of these shirts, which is your final product. So, what it says, if the whole or part of the goods resulting from such operations, that is the shirts, are exported. So, if your shirts are exported, the import duty on what? On the waste is to be remitted on the condition that the waste will either be destroyed or if not, and if you want to clear the waste, you will have to pay the duty. So if your shirts are exported, then the waste is also not chargeable to customs duty. One, either you destroy it. Two, if you do not want to destroy it and you want to bring it into India, then you have to pay customs duty on the waste portion. Second, if whole or part of the goods resulting from such operations, that is the shirts in my example, are cleared from the warehouse for home consumption. So shirts are cleared in the India. Obviously, now there is duty on the shirts also and also on the waste which resulted from the manufacturing process. So in short, if final product is exported, you may get relaxation on the duty component of the waste also. If not, duty will be leviable on the waste as well. Now, when you want to remove the goods from warehouse, what are the options? One, you can first transfer it to another warehouse. Two, you can pay the duty and clear it for home consumption. Three, from there you can re-export the goods. Now, during the time the goods are kept in warehouse, if some goods are lost, but what type of loss? A natural loss. So, like certain goods can be evaporated over a period of time. So, where your goods are volatile, that is, they will get evaporated, they will sublime, and because of which the quantity of the goods is reduced. So, effectively, when you are clearing them from the warehouse, the question is, I had imported 90, I had imported 100 kgs. I am now left with 98 only because 2 kgs are my natural loss while the goods were in storage. Now the question is, while clearing, whether I have to pay duty on 98, that is what I'm actually clearing, or 100, which is including the natural loss. The answer is in the original discussion that ultimately customs is on goods which are cleared finally into India. So if you have not cleared something into India, there will be no customs on that component. And in that particular case, you will not be required to pay duty on that 2 kgs. Just So where there is a normal loss, and since you have not cleared the goods, there will be no custom duty implications. Fine, let us proceed. Chirag bhai, it is very urgent. Please call. Now let us move on to the next topic, which is of refunds. Now in customs, what is this refunds for? So we all know refunds will arise whenever there is an excess payment of duty. Now here, which duty we are talking about? Whether the duty paid at the time of import, that is the import duty, or the export duty. So refund can be of any duty which is paid in excess. See, one is a refund like in case of GST, where if you are exporting your final product, I allow you refund of the duty which was paid on the goods which you had purchased, which we call as ITC. Here, it is not like that. This refund under customs is where you had wrongly paid excess duty, which was because of wrong assessment. Now, what does the point says? Eligible person to claim refund of duty, maybe even interest. Eligible person for claiming refund of duty or interest is the person who has paid the duty in excess and most importantly has borne the duty incidence. Now this is very, very, very important. We all know this, we have studied earlier when we were dealing with GST refund also. There is something called as principle of unjust enrichment. What is unjust? Unjust means unfair. Now, if let us say I have paid a duty and I have collected it from you and paid the duty. It means the duty burden, the duty incidence is on you. Now, tomorrow, this duty, which I had paid because I am the supplier, so I was liable to pay, but I have collected from you and paid. This duty, if it is found to be refundable in future, the law is very clear. This duty will be refunded to that person who has borne the burden. If you have borne the burden, I cannot claim the refund because if I get the amount which I had not paid, but I am taking the refund, it will be unjust enrichment. On similar lines, the entire indirect tax law says that wherever there is some duty burden and that duty burden is passed on to some other person, the refund of that duty will also be given to that other person. So that is what is clarified over here. Who is eligible? So eligible is the person who has borne the duty burden. So whatever duty is paid in excess by mistake, that can be refunded. For this, you have to apply within 1 year. And in case the duty was paid under protest, that is, there was some assessment whereby the officer was demanding X amount, which you felt that no, you are not required to pay so much of amount because your assessment is of a lower amount. But the officer insisted that until unless you pay the whole amount, your goods will not be cleared. So you paid the duty, but it was not paid by accepting, but by protesting. So that is what is called as duty paid under protest. Where duty is paid under protest, you can get the refund at any time. That is, there is no time limit for getting the refund. Now, in order to get refund, the refund should be of more than 100 rupees because if the amount is so less, then the government does not want to waste the time in the procedure of formalities. So they have given the minimum limit of refund as 100. Now, this is the doctrine of unjust enrichment, which I was just mentioning, which is applicable to all indirect tax laws, including excise, including customs, including GST. So wherever amount is refundable, why? So it is proved in the final assessment that yes, tax which is paid is higher. Actually, lower tax was supposed to be paid. In this particular case, the importer who has borne the duty burden can apply for refund. Now, in case it was not proven by the importer that he has borne the duty burden and the duty burden was shifted, in that particular case, as we discussed, the principle of unjust enrichment says that the importer cannot take the refund. But in this case, the same unjust enrichment principle applies on the government side also, because if it is proven that this duty is excess, so even government cannot keep that duty. That is why there is this provision in all the indirect tax laws that wherever amount is refundable, then if it cannot be given to the person who is applying or claiming, it would be credited to the consumer welfare fund. Just give me 2 minutes, students. Students, I'll need some time because I have a urgent call. So we'll take our 15 minutes break now. So let us take the break. We will start at 7:35. Now, so this is about the refund. So the doctrine of unjust enrichment equally applies to all refunds under all indirect tax laws. Now, the law has provided the scenarios when the amount of refund will be given to you and not transferred to the consumer welfare fund. So first, if the importer exporter has not passed on the duty incidence, then obviously it will be given to you. Second, the buyer who has borne the duty incidence. So let us say the importer who imported, he passed on the duty incidence to the buyer. Now, if the buyer is filing the refund application, the buyer should be able to prove that he has not further passed on the duty incidence. Third, imports are for personal use. Anyways, if it is for personal use, there is no question of passing on the incidence. Fourth, it is the refund of export duty, because export duty, no person sitting outside will be paying you that. So obviously it would have been paid by the exporter. So the duty burden is not passed on. Fifth, it is the drawback of duty. Or sixth, it is the duty interest borne by the applicant. And last, duty paid in excess by the importer before order of clearance. Now, if it is before order of clearance, again, see, what you understand from all this is, in all these cases, the duty incidence, the burden has not passed on, and hence the refund will be allowed. Now, if this refund is given to you late, how much late? From the date immediately after expiry of 3 months from the date of receipt of the application. So you file the refund application within 3 months. If you get the refund, no problem, no interest. But if you are getting the refund beyond 3 months of filing the refund application, interest at the rate of 6% will apply. Next comes refund of export duty in some specified cases, which says after export, if your goods are returned back or goods re-imported within 1 year after the date of export, or not or sorry. So in these two cases where the goods are returned back, maybe because of rejection, or where you had exported the goods, they are re-imported back by you within 1 year. In both these cases, you are allowed to take back the export duty which you have paid. You have to make application within 6 months from the date of clearance of your goods for export. Similarly, when refund duty can be claimed as a refund, so the conditions are, you means the importer proves that why the import duty which you are paying, now you are demanding back as a refund because the goods which were imported are defective, or they are not satisfying the parameters, the specifications with which you wanted to import. Second, you have identified that yes, these are the same goods which were imported. You have not claimed any drawback, and you export the goods or relinquish the title or destroy or render them commercially valueless. So either you send it back, or you relinquish your title to the goods, or you destroy them. In all these cases, the duty paid by you will be refunded back. You have to make application within 6 months from the relevant date. And if the goods are perishable in nature, the government may not provide you the refund. Now, what is the relevant date from which the refund application timeline would be counted? First, in case goods are exported out of India, it is the date of order permitting the export. In case you are relinquishing the title on the goods, this is applicable for import goods, the date of such relinquishment of title. Where goods are destroyed or made commercially valueless, the date of such destruction or making it commercially valueless. So this is the relevant date for deciding the timeline in which you have to make application. Gopika is asking, yeah, okay, fine. So this is about the topic of refund. Now we go to the next chapter, which is on foreign trade policy. Now, what is foreign trade policy? As international trade starts growing, every country is providing different incentives, different benefits to those people, majorly who are exporting. Along with this, slowly and steadily, special concepts for providing special status like EOU, FTP, EHTP, STP, all these statuses are created. Then further, new concepts start getting added up like advance authorization, EPCG license. Then further new concepts come like what we were discussing in the chapter of warehousing. We are allowing you warehousing within, we are allowing you manufacture within the warehouses. Similarly, very recently, the government came up with another scheme called as Mover, MOOWR. So what I'm trying to tell you is, as our international trade expands, the government takes various measures to give benefit, especially for exports, or to make imports procedurally easy, at times even giving relaxation, at times government sign special FTA agreements with different countries. So all these things happen. Now, all these things have to be regulated by a single document, so that tomorrow it is easy for the government also to monitor. Plus, it is also easy for the trade and industry to understand ki whether they are eligible for a particular benefit or not. Now, to bring all this at one place, the government decided to make a special separate policy document which they named as the FTP, or the Foreign Trade Policy. So this is what is our topic, where we are trying to discuss what are the different measures which the government has taken for promoting exports and for providing some concessions in procedures, in compliance when it comes to international trade, which is part of this FTP, that is Foreign Trade Policy. So let us try to understand some major aspects of this FTP, that is Foreign Trade Policy. So we'll be studying what? Salient features, administration, content, trade facilitation measures and measures for ease of doing business, then some special provisions relating to import export, and then various duty exemption remission schemes like EPCG, then some special category status given to some specified businesses like EOU, EHTP, STP, etc., and then deemed export. Now, the Ministry of Commerce and Industry is what is governing or regulating the foreign trade, and the FTP policy present, what we all are dealing with, is the FTP 2023 updated till date. It is notified by the central government via the powers from Foreign Trade Development and Regulation Act, amended till date. So the main governing legislation for FTP, that is Foreign Trade Policy, is this Foreign Trade Development and Regulation Act. Now, what does this act provide for? This provide for the development and regulation of international trade by facilitating imports and augmenting exports. So this is what is the purpose. Now, what is this foreign trade policy? So in exercise of the power given by Section 5 of this act, the Ministry of Commerce and Industry announces its integrated foreign trade policy. So basically, as I was explaining, when foreign trade started expanding at different points of time, government started bringing different measures. Some measures were for giving exemption, some measures were in the form of special schemes, some were for only relaxing procedural compliances, some were giving special status. So basically, foreign trade policy is nothing but bringing everything at one place. This policy was earlier called as EXIM policy, that is export import policy. Now it is called as FTP. So what are the salient features? So export import of goods is generally free unless specifically regulated by the provisions of the policy or law. Export imports are broadly categorized as free, restricted, prohibited. Acha, here free does not mean duty free. Free means allowed without any permission from the government. See why this word free is important, because there was a time before 1990s, before we opened up our economy and we adopted global economy. Before that, for anything you wanted to do, even export, you had to take permission. And for imports, there was even stricter regulations and licenses that were required. That is why that era is also called as the license Raj era. So when here we are talking that export imports is generally free, free we do not mean duty free. Here also they have categorized the export import into three categories. Again, free does not mean duty free. Free means free from any restrictions or any type of license requirement. Means tomorrow if I want, I can directly give any exporter that order who is sitting outside India, and that goods can directly come to me, obviously on paying the relevant duty, but I will not require anybody's permission or there will not be anyone who will be stopping me from doing that import export if my goods services are in the free category. Free means free from any licensing. Then the second is the restricted category, where certain goods will be allowed to be imported, exported, but only by specified persons or only on getting specific licenses. That is restricted category. And third, where the government outrightly rejects or denies the import export. Next, some goods are free for import export but can be imported exported only through. Now, this is free but with some restriction or with some condition. That is, as a single person, you cannot import or export it. You can do it only through some organizations, some bodies which are created by the government, which are called as STEs, that is State Trading Enterprises. This is also done by the government because there are many times exporters whose quantum is so low that it is infeasible for that person to export. So to provide them hand holding, the government has created such type of entities which are called as state trading entities, which are basically government units only or government run bodies only, which help importers, exporters to do foreign trade. And there can be certain goods on which this type of restriction is kept, that you can import it. There is no other license required, but you cannot do it directly. It has to come through STE. Further, there are restrictions on export imports for various reasons, which can be strategic, health, defense, etc. If goods are restricted for export import but not prohibited, the government can give the permission license. So that is what is restriction. So restriction is you can import it, but it will have to go through some procedure like getting some license or permission. Exports generally are promoted using various schemes. So this is major part of FTP. Goods and services to be exported, but not the taxes. This is what is one of the, you can say, bottom line themes of EXIM policy and now FTP, that only goods and services should go out, not the tax portion. And that is why exports are made duty free, so that to that extent the value of export is less. This also makes your goods competitive. Plus, the general policy is we do not want to export taxes. Then capital goods can be imported at nil rate for specific purposes of using it in export, using the scheme of EPCG, so on. So these are the various features. Now here, what is very important is understanding WTO provisions. So when we talk about any type of concessions, or let us say any type of even restrictions, so generally we will try to restrict imports and we will try to concessionalize exports. But in both these things, we have to keep in mind WTO guidelines. In fact, if you follow news, if you are interested in international news, you will find time and again there is always a rift going on, where when Indian government gives some relaxation measure, immediately China and all these countries, they lodge a complaint against the Indian government with WTO, stating that we are going beyond the WTO parameters or guidelines. So what are the four main WTO parameters which we have to incorporate whenever we are making our FTP? What are they? We should allow trade without discrimination. Means what? We cannot say that we will not allow import from China, but allow the same thing to be imported from some other country. So that discrimination cannot be done, obviously, until unless there are valid reasons. Second, predictable and growing market access. Again, I cannot restrict the access of my market to anybody who is outside, because doing so will never make foreign trade free and fair. So I should not do that. Next, promoting fair competition, and last, encouraging development and economic reforms. So whenever I am bringing in anything in my foreign trade policy, it has to follow these four parameters put by the WTO. Now, who is administering the entire FTP? That is, who is making the policies or giving suggestions and then finally implementing it? It is the DGFT, Directorate General of Foreign Trade. So this is one of the departments in the Ministry of Commerce and Industry, and this department is exclusively looking after the foreign trade policy. So the policy formulation, the policy implementation, and even handling the hiccups, or if somebody is breaching any of the policy clauses, everything is done by DGFT. So what else DGFT does? It will also issue authorizations. So wherever you want a special status or wherever you want to avail of a particular scheme or benefit, you require some documentation. And the first step is getting the authorization. That is done. Further, for any importer exporter, the very first thing required is you require that import export code using which only you can do import export. That is also provided by DGFT. Further, whenever there is any dispute and it is going to DGFT, the decision of DGFT is final and it will be applicable to everyone. Most important, DGFT has made a handbook of procedure where you will find the details of the procedures, the various types of forms, the various types of timelines, everything provided therein. Further, there may be some relaxations given from certain policies or from certain procedures, but only to some specific cases, which may be specified class of importers, exporters, or maybe to specified import export categories. Some other authorities which are directly indirectly connected with FTP. First is the CBIC, because as we all know, every commodity, whether goods or service, has different types of indirect tax burden, and no country would want that its good become costly in the foreign market only because of the burden of tax. So the very first purpose of FTP is ensuring that whenever there are export of either goods or of services, they are done without having any indirect tax element in its value. But to do this, we require some specific exemptions relaxation in the respective indirect tax act. So for that is how the role of CBIC comes into picture. So when FTP is drafted and whatever policy measures or relaxation measure FTP is providing, many of them are tax related. So it has to be incorporated in our respective indirect taxes, which is taken care of by CBI. See, then there is RBI. As we all know, it is the banker's bank, it is the topmost bank. Now, in every international trade, the most important component that comes into play is the forex. Now, when we talk about forex has a direct bearing on any country's economic status and even economic stability, which is that is why under control of RBI. So, since forex is the medium through which foreign trade would be done, and since forex is regulated, monitored by RBI, so there is some direct indirect role of RBI whenever FTPs are formulated. And then it is the state GST departments. Why state GST departments? Because whenever any tax related regulation has to be done, it will be routed through the GST departments. Now, if somebody has to read and understand foreign trade policy, what are the things that this person should refer? So first is he has to refer to the basic policy, which is called as FTP. The last policy drafted is 2023, and it is having amendments even day in, day out. But the last main policy was in 2023. This policy document is divided into 11 chapters, giving the entire policy from different perspectives. Then further, you have a separate document called as Handbook of Procedures. In this, the procedural part is given. So policy says, okay, we'll give you relief, but how the relief will be given or how a person can seek for the relief, or the policy says we'll make import duty free if you are using it for export, but how this will be ensured. So what are the forms, what are the authorizations, what are the licenses, everything in detail is given in this. Then comes ITC HS classification. So what is this? So we have the harmonized system. Now, one we studied when we were discussing the chapter on classification, where we discussed that there is a harmonized system of nomenclature given by WCO, World Custom Organization, which is implemented in customs, GST everywhere. Similarly, we have another harmonized system, which is for coding. Now, this is done so that standardized codes are given to different items, different goods, services, and these codes play a very important role because whenever a policy has to be drafted, the government wants data. So, how data will be collected? It cannot say, I want data for shirts, it will give the code so that a very precise and proper data can be collected from the industry, from the various industry bodies, from the various government departments, so that a proper policy can be made. So, for the purpose of data collection, compilation, it is always better that goods and services are represented by code so that there is no error while using the name. Because we all know a particular commodity may be known by different names in different places within India. So it will be very difficult to have a proper data compilation. That is where this HSN, not HSN, sorry, Harmonized System of Coding, HSC, is relevant. Then is the internal role play between the foreign trade policy with various tax laws, which includes majorly the indirect tax laws. So as we have been discussing from start, since the value of goods are directly impacted by the quantum of indirect taxes embedded in them, hence for giving any relief, you have to involve the taxation aspect. So this is how both these things have an interlinkage. Now, when we read the foreign trade policy, what are the different components of the foreign trade policy? So that you can find in this table. So the contents of foreign trade policy is divided into first, the legal framework, including trade facilitation, general provisions relating to import export, then developing districts as export hubs, duty exemption remission schemes, then the EPCG scheme, then the export oriented units, EHTP, STP, BTPs, and all these things. So this is how those 11 chapters in the foreign trade policy are drafted. Now going to details of these chapters. So first is the trade facilitation and ease of doing business. Now we all know that in order to promote trade, both domestic and international, it is very important that various hurdles, various hiccups that the industry faces, that a business faces, has to be addressed and has to be removed. For this, we use a terminology for which we are also having a ranking, which is called as ease of doing business. So you would be seeing that in past few years, our ranking internationally also in ease of doing business has improved. Now, this ranking is dependent on what? How is this ranking or this ease of doing business criteria determined? So here there are some parameters which is the basis of determining what is your ease of doing business ranking or parameter. So it is first improving the ease of doing business through reduction in the transaction cost and time. Then reduction in cargo release time. So first is time and cost gone in doing a transaction. Like I'll tell you a simple example. Before you had this UPI and this online payment, and let me tell you, India is the pioneer in this. In fact, many developed countries, including a country like US today, is still not having that immediate payment mechanism which India has. This is this has reduced our transaction time and obviously the cost to very minimal. Earlier, if I had to buy something from someone, how I will make payment? I will make payment by giving a check which will go to that person. That will take 2 3 days by post or courier. He will deposit the check in the bank. It will take 3 4 days more to clear. And if it, all this is international, it may take even 10 days. So till 10 days, your transaction is not complete or close. Then came the banking mechanism of doing NEFT, RTGS, but still that also takes 2 3 days. And again, in case of international transaction, even more time. But the moment you have this UPI and nowadays the scanning of QR code and all, this same transaction is happening in fraction of a minute, hardly in 5 10 seconds. So this is how ease of doing business is improving. So first parameter is transaction time and cost, then cargo release time and cost. So whenever any cargo which is imported, exported, how much time it will take to release from the custom ports. Many times it takes months. So to that time, your business is stopped because you're not getting the goods in time. Then paperless regulatory environment. Again, we have moved towards this. So you'll find today almost all our taxation laws are emphasizing on portal-based compliance, portal-based registration, and paperless governance. Another parameter is transparent and predictable legal regime. What is a legal regime? So whatever laws are there in the country, all laws, taxation laws, criminal laws, then laws relating to managing, running business, and even relating to safety security. If these laws are stable, if these laws are easy to understand, so they will become transparent. And if a common man is able to interpret it, they will become predictable. If it is too confusing, too complex for interpreting a simple, let us say day to day required contract laws, I require a lawyer, then my business time will be wasted. So, simplifying laws, making the application of law simple and transparent is another important role of ease of doing business. Then, improvement in the investment climate. Every business requires investment, and we all know that it is very difficult for the owner promoter to pump in all the money. So you will definitely require some outside finance, which firstly would be from banking. That is obviously the very first source. But today you will see that even a smallest of business is eligible or is having that environment to raise funds domestically through banks, through NBFCs, then through various funding mechanisms. You have venture capitalists, you have angel investors. Nowadays, the Shark Tank has brought in a new concept that you pitch your idea, you get finance, you get investors, and the same thing is possible internationally. And now, suddenly, you will find there is a IPO boom. Everybody is working to bring in their IPO. So, this is how the climate and the infrastructure for getting investment has improved. All these things add up to your ease of doing business. Then trade facilitation measures introduced with an option available to the government for consultation with relevant stakeholders to seek their view, and also providing the mechanism on best endeavor basis to inform reasons for not accepting views, etc. Fine, that is okay. So before bringing in any policy changes, firstly, the policy is discussed with the stakeholders so that their views are taken. And depending upon their inputs and views, if the policy can be bettered, if the policy can be made more industry friendly, all suitable actions are taken to remove the conflicts, to provide a better say of all stakeholders so that everybody's point can be considered. Then we have a concept called as authorized economic operator, that is AEO. What is that? It is a business entity engaged in international trade, is granted the AEO status if it is approved by customs as compliant with supply chain security standards. Now, what is the benefit? AEO status holder gets extensive benefits, including preferential custom treatments in terms of reduced examination and faster processing and clearance of cargo. So once you get this AEO status, your benefit is you will get preference at the time of clearance of cargo, plus you may get duty deferment option. You may even get direct port delivery or entry. So many procedures which are to be followed by many are simplified, are eased out for you if you are a AO holder. Then there is a new concept coming up, which is town of export excellence. Now, what is this? This is also promoting one more thing, that is overall regional development of the country, because you'll find that only few cities or few areas in the country are rich in terms of industrialization. So there is a concentration of industry which leads to a lot of pressure on the social structure and infrastructure of that area, and at the same time other areas are deprived of the development. To overcome this, this concept of TEE was brought in, whereby some towns will be selected. Now, these towns obviously will be the one which are not already developed. And what will happen? The government will try to develop these towns in such a fashion that tomorrow these towns can contribute to Indian exports. How? So they will create infrastructure, they will bring finance in this particular place, and they will ask people belonging to that place plus outsiders who want to come and set up their businesses in that town, so that that town can be exclusively involved in making those goods which have export relevance. In fact, you'll find that today we are following a concept which was brought in immediately after COVID, that is local se vocal, या local के लिए vocal. So what is that? Government is now trying to promote export of our local products, so that even our smallest town item which a smallest town person is making should have some market internationally, which will even bring money to that person, plus bring prosperity to that town, and also have an overall image of India in the export market or international market. Then there is another concept in foreign trade policy called as status holders. Now again, status holder is a, you can say, categorization or a classification made whereby those exporter firms who are recognized business leaders and who have excelled in international trade and have contributed to our country's foreign trade, they are given this particular recognition called as status holder. Again, same like that AEO recognition, this status holder recognition is given to some specified firms who have met the export performance, the foreign currency inflow performance in last 3 financial years. And this performance or this status holder will benefit them in multiple ways. So firstly, what is this status? So they have made different categories and they have given them the parameters. So 1 star, 2 star, 3, 4, 5 star. Now, how much export you have done, that export performance determines you will be given which status, right? Now, how these exports will be counted? The performance shall be counted on the basis of FOB value of export earnings. Then for deemed export, the FOR value of export in Indian rupees shall be considered. Now, for granting status, export performance of last 3 financial years will be taken, and export performance is not transferable. So, if I am having surplus export performance, I cannot give it to other entities so that they also match a particular parameter. So, that is not allowed. Export made on re-export basis are not counted. Export of items under authorization, including SCOMET items, would be included. And for calculating export performance for grant of 1 star export house rating, these all different things would be considered. Now, what is the benefit of becoming this one of these status holders? So firstly, authorization custom clearance will be on self-declaration basis. This is the biggest benefit. See, otherwise in customs, majority things are controlled by the officer. So for you, it will be on your self-declaration. Then for you, the input output norms will be fixed on priority, maximum within 60 days. Then exemption will be granted for compulsory negotiation of documents. So you will be given relaxation by not asking you to give documents for everything. Then further exemption will be granted from giving bank guarantees. So many times for specific performance, you have to give bank guarantees. That would be relaxed for you. For 2 star houses and above, they are permitted to have their own export warehouses. So that will always, so these are the various facilities which you get once you become a status holder. Now, similar to TEE, there is another concept of developing a whole district as export hubs. So I'll give you a best example. So there is a place in Tamil Nadu which is called as Tirupur. If you go to that place, you'll feel that it is a very small place. In fact, the lanes, the roads are also very narrow. It is a single road that passes through the entire city except for few places. But that city or that district contributes to 40% of our Indian hosiery exports, despite of being small. Why? Because that entire district is so organically it has evolved that right from thread to the final product, that is t-shirt and its packing and its buttons and its print material, everything is there locally. So even the output means final making the final output from the raw cotton, that speed is fast. Plus, because everything is available locally, the costing is low, and plus because the people over there are skilled, which is very important in all the requirements. So if somebody wants to get printing done, you have a special area where all printers are there and they are skilled in their work. Then you want a particular type of cutting or stitching done, you have specialized people. So all these things has become like a complete ecosystem, which has led to making that one small city or district as a export hub. So this is how the FTP is targeting to create such export hubs for various products in different parts of the country. Then, many times there are disputes relating to quality, and these disputes may eventually lead to cancellation of the order. So, again, there are measures whereby separate committees are formed who will be taking care of all these complaints and disputes so that tomorrow these are not repeated. Then comes a special category which is crafted called as comet. We call the goods falling in this as the comet items, or this comet list is there. Now, what is this comet? Comet is a short form. The long form is special chemicals, organisms, materials, equipments, technology. Now, this list, which covers different items falling in these categories, is called as the comet list. Now, the items which are in this comet list enjoys lot of relaxations, lot of benefits when it comes to international trade. So within FTP, there is a special chapter for comet so that firstly, goods which will fit in this list are identified, and then the special benefits which are given to them are provided in that particular chapter or list. Then provisions regarding imports and exports. Now, there is nothing very special given over here because main procedural part is already there in customs, which we studied today only. But what it deals with? So firstly, it says that we will classify the items into three categories where import export is allowed without any license or permission, then where some license permission will be required, or those which will not be allowed at all. Then those which will be required to be done through state trading enterprises only, which cannot be done at your individual level. All these things would be done through or regulated by the DGFT, and it would be done by way of issuing notifications from time to time for various things. Now, the general provisions relating to import exports which are provided in FTP are firstly going for that harmonized coding system so that all data can be compiled, can be worked out using those HSN codes so that there is no mistake. And then on that basis, on the basis of this data collated, compiled, proper action, proper policy making can be done. So as we all know, even in our Customs Tariff Act, Schedule 1 deals with the import goods and Schedule 2 deals with the export goods. Here we have three categories. Schedule 1 for import policy related things, 2 for export, and 3 which is special for SCOMET. Next thing is the state trading enterprises. So this ITCHS specifies again certain goods that they can be imported, exported only through state trading enterprises. So for certain goods, this restriction is kept. However, the DGFT has the description to issue authorization entities also to import export these goods, which otherwise are allowed only through STEs. Some of these STEs are so Food Corporation of India, Oil and Natural Gas Corporation of India, National Fertilizer Limited, etc. Then you have the IEC Import Export Code. This is based on your PAN. So on the basis of the PAN, or you can say it is the PAN link number, like how your GST number is a PAN linked number. This IC code is also PAN linked number. So this IC code details have to be electronically updated every year, even if there are no changes, failing which your validation will be deactivated. Next, certain documents have been mandated. So for export, you require the bill of lading, airway bill, lorry receipt, etc. The commercial invoice and the application for export, which is shipping bill of export. For import, similarly, you require the bill of lading, airway bill, etc. The commercial note, the commercial invoice, and now the bill of entry. Then what is provided in this import-export procedure is the penal action and placing of an entity in the denied entity list. Now, what is this denied entity list? If you are a repeat offender, if you are a regularly non-complier of any of the procedures, or you always breach what is given in the policy, you are put in this DEL, that is denied entity list. Now, what will happen once you are put in this list? You will be disentitled to get certain licenses or authorizations, or you will also be disentitled for renewal of your existing license. Now, you all can understand that if either you are not given a license or your existing license is not renewed, so that will lead to direct loss of benefit, because whatever benefit in relaxation in taxation or procedures you are enjoying, that you will be disentitled to enjoy. Next, this you have to, I'll say, understand and keep in mind. For certain beneficial schemes, there is a concept called as actual user condition. What is this actual user condition? So for certain schemes, let us say I say I will allow you duty-free import. And for this, there is a scheme called as advance authorization, or there is a scheme called as EPCG. Now, under these schemes, when I allow you duty-free import, I have the right as government to impose some conditions. Now, this condition requires that if you are importing something duty-free, then it is only you who can use it. Nobody else can use it. Or in other words, you can say you are not allowed to transfer it to anybody else. So this is what is the actual user condition, whereby only you, that is the person who is given that particular authorization or license, can use that, and he is not allowed to sell it. If after importing it under any of the beneficial scheme, if you want to sell it, you'll have to pay the entire import duty. That is how the actual user condition is. Next, then import of certain items have been given some relaxations or have been imposed with some restrictions conditions, like samples. Import of samples of restricted items is given relaxation that it will be allowed without any authorization. So the actual item may be a restricted item which may require some license, but its sample is given the relaxation, because many times you first bring sample which is in one or two quantities, and after testing, after using, you may place the order. At that time, you may take the license. So the samples may be allowed without authorization. However, exception to this relaxation is defense or security items or certain seeds, bees, etc., which will need authorization even for samples. Next is gifts. Imports of gifts, including those purchased from e-commerce portals or through courier and post where custom clearance is sought as gifts, is prohibited. Means what? You cannot import anything under the category of gifts. Why? Because this could be a way to evade tax. So they have restricted this. Restriction means you definitely can get gifts, but it will be taxable. It cannot be allowed duty free. Exception to this are Rakhi, life-saving drugs. Gifts, however, can be imported upon payment of applicable customs duty. So otherwise, if you say gift, it may get relief of not paying customs duty, but that is what is restricted. Then you have the baggage rules, which we discussed very recently. So for allowing the baggage of persons to be cleared without payment of duty, the FTP provides some provisions, like whatever are your bona fide household goods and personal effects, they will be allowed duty free. Samples of items can be allowed duty free. Then drawing patterns, label, price tags, button, belts, etc. These will be allowed duty free, etc. Then procedures for re-import of repaired goods. If you remember the starting chapters, we had this special point that if you are sending goods outside for getting repaired and they are re-imported, then there should be no tax on that except towards the cost of repairs. Then goods used in projects abroad. So project contractors, after completion of projects abroad, may import these goods without any authorization. Goods may include capital goods used in the project, provided they have been used for at least 1 year. Then the next procedural part is relating to prototypes. What are prototypes? So prototypes are, so let us say there is a machine which you want to buy from Germany. But before that, you want to have a model of that machine to know how that machine looks like, how it will function, what will be the area, etc. So you can get a prototype of that machine from the country. So you can say it is like a sample, but for machines and all, we do not call it as a sample, we call it as prototype. So prototype is a better word for samples of machinery items. So even new second-hand prototypes or samples may be imported without authorization with following condition. First, the importer is the industry who is going to actually use it. Second, it is engaged in production of or having industrial license letter of intent. Next, the importer files a self-declaration that he is doing it for his own personal use. Then special procedures for metallic waste. Imports of any form of metallic waste scrap shall be subjected to condition that it will not contain hazardous toxic waste, etc. Only subject to this, export or import of waste items is allowed. You would be knowing in between there was a period where India was used as a dumping ground for some waste which were actually very hazardous even for human and even for environment. Now all these have been blocked and now they are not allowed to be imported or dumped into India. Then we have a separate policy for import of second-hand goods. Now, what is that policy? So, second-hand goods are classified into two categories: capital goods, other than capital goods. Within capital goods, we have free for import. Free for import means again not duty free. Free means without any restriction or licensing. So, this covers refurbished or reconditioned pairs of capital goods for which a chartered engineer certifies existence of 80% residual life, and all other second-hand capital goods other than those listed above. Now, where there is a restriction, restricted for imports and require authorization. So these capital goods, if second hand, will be allowed but subject to some conditions and permissions. What are they? Second hand air conditioner, DG sets, computers, refurbish or reconditions pairs of refurbished parts of personal computers. Because many times you will bring parts and assemble here and make it a computer. So that has also come under this list. All notified electronic and IT goods, used IT assets imported from SEZ to DTA. So if you see, majorly it covers all electronic items for two reasons. One, I was just mentioning that there was a period when there was a lot of hazardous waste being dumped in India. And many times these waste were electronic waste. Now, strangely, in order to bypass the restriction of waste and scrap, they were getting imported as second hand because anyways they were used. So instead of calling it as waste and scrap, because in that case it would be restricted, people started importing it under the name of second hand. So you will find these goods even having restricted under the second hand category. Then for other than capital goods, the two categories are imported for the purpose of repair refurbishing. They are freely importable subject to some conditions, and other goods, they are restricted for imports and can be imported only with prior permission and authorization. Then comes certain items for which you are allowed these benefits, which is advance authorization, where you are allowed to import them without compliance of the mandatory quality control. So that is what is the benefit given. So firstly, what is advance authorization? So advance authorization is where I'm importing something which I'm claiming that I will be using these goods in making some export items. Then I'm given an advance authorization whereby I can import them duty free and use it in making the export goods and make exports, so that ultimately the goods go outside, and that is where I am given the duty exemption. We all know what is EOU. So EOU is a specific status given to those units which will be exclusively manufacturing the goods for the purpose of export. So majorly their output will be export. That is what is EOU. SEZs are special areas which are demarcated. Again, these are mainly done for export promotions, though they are allowed to sell goods within India also. But the difference is an SEZ is having a status equivalent to that of a foreign entity. All these are excluded or exempted from the compulsory conditions of the quality control. So that is what is the benefit given relating to these units. Then some miscellaneous provisions relating to imports. So goods for import into India can be sold while they are in high seas. Next, merchant trade. That is where you are buying goods from one country and you are selling it to other country. This is also allowed without the goods coming into India. However, this will be allowed subject to RBI guidelines because foreign currency involvement would be there. And this is allowed except for goods in the CITES and the SCOMET list. For merchant trade carried out within one specific foreign country is also permitted, again subject to RBI guidelines. Then import of capital goods under lease financing does not require permission from DGFT. So what is under lease financing? So I'm not purchasing the capital goods, but I am getting the goods under finance. So I am actually getting purchasing the goods, but the amount is paid by some finance company, and I am now paying lease rentals to the finance company. Then for imported goods, bank guarantee, letter of undertaking, bond is to be executed with customs in case you want to bring it duty free for some specified purpose. So there is a condition requirement for giving bonds. Then some provisions relating to export. First, benefit for supporting manufacturer. So supporting manufacturer in one who manufacture goods produced or any parts accessories of goods products for merchant exporter or manufacturer exporter under specific authorization. So you can say these are like many times job workers, or these are the contract manufacturers who are actually manufacturing goods for some other person who is going to be the actual exporter. Next is for third party exports. So third party exports are also allowed. What it means? It means that the exports are made by exporter or manufacturer on behalf of another exporter. In such cases, export documents such as shipping bills shall indicate names of both manufacturer exporter and the original manufacturer and the third party. Next, samples export of trade and technical sample of goods of freely importable items are allowed without any limit. So what is allowed to be imported as sample is also allowed to be exported as sample. Again, for gifts, goods including edible items of value not exceeding 5 lakhs in a year may be exported as gift. However, item mentioned as restricted for export shall not be exported as gift without permission. Again, for passenger baggage, bona fide personal baggage may be exported either along with passenger and if unaccompanied within 1 year before or after passenger's departure. However, items which are mentioned as restricted for exports shall not be exported as gift without authorization or even as baggage. Next is import for export. Now, what is import for export? So actually, you have an export order on hand, but the goods are not domestically available or economically it is not viable to purchase it domestically. So you are importing the goods, but the purpose is that these goods are meant for export only. So the goods that are freely importable as well as freely exportable can be imported and then exported in same or substantially the same form without authorization. Goods including capital goods, both new and second hand, can be imported under bond and then cleared for export against freely convertible foreign currency, provided they are freely exportable. This includes goods which may be restricted for import. So capital goods that are freely importable and freely exportable can be imported for being exported by giving LUT or bank guarantee. Besides the above, goods of other than Indian origin that are restricted for export but free for import can be imported for export in same or substantially the same form. So these are some relaxations given wherever imports are done for export. And then the next point is payment and receipts on account of import export. So first, denomination of export contracts. Export contracts may be denominated either in Indian rupees or even in freely convertible forex, but proceeds should be realized only in freely convertible forex. Again, for some specified cases, export proceeds may be realized in Indian rupees subject to conditions. What if these proceeds are not realized? If exporter fails to realize export proceeds within the time specified by RBI, I'll just give you today's update, not relevant for exam, but for your knowledge. Today's update is that RBI has extended the time of bringing in money in India from 9 months, which was the original time provided in FEMA, to 15 months. This is today's update, not relevant for your exam, just for your knowledge. So, if an exporter fails to realize the export proceeds within the time provided by RBI, he shall be liable to return back all the incentives which he has availed against export, because export is not only confined to sending goods outside, it also requires the payment to be realized. However, if such non-realization is for reasons beyond his control, he may get the above restriction waived from RBI. Export credit agencies. So these provide financial supports to exporter. They support exporters by insurance, guarantee, and also direct lending. Then you have export promotion councils. So these are bodies which are set up. Generally, these are mainly government bodies. At times they are under PPA, that is public-private partnership, sorry, PPP. So these bodies are working as a bridge between Indian exporters and foreign buyers. So these bodies, firstly, they uh, enroll various people as their members, and then it provides them various supports. They organize exhibitions for these people so that their products get marketed in foreign country. These export promotion councils help the Indian industries to identify probable customers. So this is how export promotion council works towards export benefits to the Indian industries. Then self-certification of origin of goods. Till now, certification of origin of goods for export was issued by designated agencies. However, now self-certification has been enabled for some specified approvers. Export. Now, who are these approved exporters? You remember we studied that status holder. So for status holders, now they need not take the certification from the agency, they can do it themselves. Approved exporters will be entitled to self-certify their goods as originated from India with a view to qualifying for preferential treatment under various preferential trade agreements. So we have signed preferential trade agreements, free trade agreements with various countries. So over there, the benefit will be given if the goods originate from India. For this, you required a certification as to the place of origin. Earlier, this certification was to be given by specified agencies. Now, these approved exporters who are status holders can self-certify the goods and that certification would be accepted. So students, these are the various aspects of foreign trade policy in a summary form. So with this, we have completed our revision of this paper. In the next two classes dedicated for revision class, we will be dealing with the statutory updates that are applicable for your exams. They have been covered in various chapters at the time of studying those chapters, but we will be also covering it separately because, as you all know, statutory updates have a special weightage in the exam paper. So dealing it separately will help you, one, revising those statutory updates, plus it will also help you by identifying you at one place what are the important relevant updates. So our next class, if I'm not wrong, we have two classes dedicated for statutory updates. We'll be covering all updates in the entire paper of indirect tax. So with this, thank you very much. We connect again in the next class, which will be dedicated for the statutory updates. Kindly revise in between so that whatever are your queries, doubts, you can get it cleared from me upfront in our upcoming lecture so that your entire revision with doubt clearance would be done. So thank you very much. We conclude our lecture here. That is all from my side. Thank you. Yes, sir. Yes, Manishi. Thank you very much. Good night, sir.